our philosophy has always been we solve for risk before solving for scale. My theory is that the CFO is, so to say, a primary advocate for maintaining discipline, be it around revenues, be it around cash flows, efficiency, runway, burn rate. Within this space, there is 100 billion of inventory that flows through three levels. So it's 300 billion of flows that we are looking to finance.
Hi, folks. Welcome back to On Call with Insignia, where we go on call with leaders innovating the future of Southeast Asia's digital economies, as we like to call it, ASEAN Innovation. I'm your host, Paolo Pina, and welcome back to another episode of Season 6 of On Call with Insignia. I think our 161st call with many leaders and founders out there making great things happen, coming out of the region. So excited to have another conversation with somebody new. It's always great to have a fresh guest on the show. But the company she's working with should be familiar to our long-term listeners. We've had the CEO on this show a couple of times over the years and really been able to track their journey. So if you've seen the title on our podcast or YouTube or wherever you're tuning in, you probably know that we are going to be talking about AwanTunai. So they are a supply chain financing platform based out of Indonesia, doing some great work for MSMEs and some pioneering work with algorithms really designed to underwrite a lot of the lending capabilities for a traditionally underbanked and unbanked sector. And I have for my guest for this episode none other than the CFO of AwanTunai, Shilpa Gautam, who is, I think, an interesting history with the company and Insignia Ventures as well, which we'll talk a little bit about later on, but also just a really diverse background in terms of a career that I think has really impacted the way she has approached working with AwanTunai, which we'll get into as well later on. But yeah, welcome to the show, Shilpa. How have you been? I think the last time that we've gotten to have a conversation was not for a podcast, but for Insignia Ventures Academy, actually, one of the classes for the Start CFO program.
That's right. So it's nice to catch up with you after, I think, almost 9 months. We had that session. I think I'd kicked off the first cohort of the
Right.
Insignia season, and that mine was the first series of many CFO talks. So it's been a while since then, both professionally and personally. There's been a lot of growth of the company. We've just closed a Series B. Things are getting busier. So it's great to be back and talk a bit more about the journey of AwanTunai. I'm happy to talk about my personal journey as well, how
Right.
I've grown with AwanTunai as well.
Yeah. So let's dial it back a little bit and go back to that intersection of how you discovered AwanTunai. And I think more critically, what was behind that decision to join this company at that point in your career? I think this was like 3-4 years ago already.
It's only been 2 years
Oh,
since
2
I've
years.
joined
Okay.
AwanTunai. It feels like
Maybe it
I've
feels
been
like
here
it
for a
feels
while.
much longer.
It's been 8x growth since I've joined. So, it feels like I've been here longer. And that's a great thing, right?
Yeah.
It feels like I've known Dino Rama forever. I was introduced to AwanTunai by one of its existing investors. And if I can name, it was actually Insignia. So thank you for that. And that point in time, I had obviously heard a lot about AwanTunai because AwanTunai had just closed its Series A round with IFC as a lead investor. Everyone has tried their hand at lending into the micro segment, but this was one startup that really caught my attention because I think this was also IFC's first investment in Southeast Asia in fintech lending. So that was really something. At that point in time, when I met Dino, I really liked the change that he and Rama were trying to bring about. So what AwanTunai is doing is we're digitizing the traditional supply chain, building a digital infrastructure in the FMCG space, and we monetize through embedded financing. We are bringing about that change in the micro segment of Indonesia, and our vision is to provide very low cost financing for micro and SMEs. And I personally believe SMEs are the engine for economic growth, and unsecured lending can unlock a massive amount of economic growth and prosperity. So for me, taking a step back, joining AwanTunai was life coming a full circle as I started my career with KPMG when I was training to be a chartered accountant. So back in the day, I had audited the lending portfolios of most of the banks in India. I've looked at what is typically the credit appraisal process, the risk controls, etc., because that's the job of the auditor. After that, I moved to Ernst & Young in London. I was right in the middle of the global financial crisis. I think I moved to London in September 2006, and then 2 years later, Lehman happened exactly on the same day to London. And at that point in time, I was an administrator to one of the Icelandic banks that had collapsed. I had built the business model of a lot of housing and mortgage companies which had collapsed and were under public ownership. I used my past experience to learn a lot about lending. And when I came to AwanTunai, it made sense because I was the first CFO that AwanTunai had. And even in my time at Citi, across India, actually South Asia and Southeast Asia, I have worked on debt and equity transactions across banks and financial institutions. So lending is one space I was super comfortable with. Indonesia was another space I was very comfortable with because back in the day, I've actually worked on an acquisition of a local bank, Indonesian
Mm.
bank, by a bulge bracket bank. So I did understand the space really well. So for me, career moves are all about recognizing and playing to one's strength. And AwanTunai seemed like a perfect fit.
Yeah, yeah, I think some great advice there for those listening, anyone listening out there who's maybe considering a career move as well, especially into a venture-backed company like AwanTunai. I wanted to delve into your role as CFO. You did mention you were the first sort of CFO for AwanTunai. What does your role mean? Obviously, there's a dictionary and technical definition for what a CFO does and is expected to do, but I guess specifically to AwanTunai's business model and what they do in Indonesia, like what does your role mean as CFO? How does it compare to other tech companies that you've been in the past or have seen in the region and other lending companies?
Sure. I think let me take the first part of your question as to what does my role mean as a CFO of AwanTunai. I think I wear many hats in this role. Okay. So my role in AwanTunai is not just focused on building robust financial reporting and a solid governance framework, but I also originate lending capital, which is a key tool for growth in a lending fintech, right? So for us, and there's this, I think, question that get asked by investors all the time. Hey, I know you're raising so much from banks. Are you able to deploy it? For me, it's not demand is not the issue. It's the supply of lending capital, which can impede or scale the business. So I work very closely with private credits and banks, convincing them, negotiating with them on the terms of the credit. Obviously, lending is all about a game of margins, trying to get the right margin so I can run a profitable, efficient business. That is something which takes up a lot of my time. I work very closely with the sales team on deployment of capital, building up sales and growth targets, right? So as of today, for instance, I have a loan book of X. I want to grow it 3X. How am I going to deploy that capital? And accordingly, I will pretty much time how I approach that lending capital, right? I also work with risk very closely because different lenders have different risk acceptance criteria. To build that trust with lenders, we need to have a very solid risk acceptance criteria internally. And I also oversee the treasury operations, and treasury can become very complex as asset allocation becomes complex with several lenders with different eligibility and risk
Mm,
acceptance criteria. So that is a couple of aspects of my CFO role in addition to financial reporting.
mm,
But I think one of the most important aspect of my role is fundraising. And it includes everything, be it investor outreach, pitching the AwanTunai business model to the right financial and strategic investors, and running with the DD process, which can be a very long, drawn, exhausting process, and reporting to the existing investors, most of which are DFIs and CVCs. So I think given my skills and experience from my previous jobs, that is also the reason why we've never hired or had the need to hire advisors or investment banks for our fundraising. Now, to your second question, as in how is it different from different tech companies or lending companies that I've seen? I believe that depending on the scale of the companies, the roles of a CFO can differ. So
right.
some CFOs are just very numbers focused, but I've also seen startups hire CFOs from, say, investment banking background with no accounting or reporting background or no risk background, which could be risky, but it's of course their call, right? But I do both and a lot more, right? So my theory is that the CFO is, so to say, a primary advocate for maintaining discipline, be it around revenues, be it around cash flows, efficiency, runway, burn rate, right? The key is to look, you know, forward 12 to 24 months and see how the numbers today will enable a 2 to 3 year strategy. Also about understanding your burn, which obviously can be different across different stages of company. So for a good CFO to understand, hey, what is the burn from a product and tech, which may bring in value, say in 6, 12, 24 months? Or what is the burn from marketing, which generates sales today? So I think one thing I've seen from my experience is I've seen where equity was easily available, the days of cheap equity before the tech winter, right? So back in 2021, when there was a crazy amount of investors' money being spent on marketing or promotion or spiking up sales with no real impact on long-term growth. So I think CFOs, depending on the stage of the company, they really need to challenge whether the spending is necessary. CFOs need to survive, build a company for survival in these tough times. So I think with AwanTunai, because I joined a Series A company, my focus was bringing in the efficiency, managing the burn, because pretty much 2 months after I joined AwanTunai was the start of tech winter. And to conserve the runway, to keep AwanTunai going until the fundraise, that was one of my key challenges. And I think hopefully I did well.
I mean, yeah, that leads into my next question actually, because AwanTunai has just raised a Series B, as you did mention, and it's quite interesting that you got some lead investors and participating investors from all over the world, right? From Norway, from Japan, Finland, Thailand. Maybe you can speak to a little bit to what is the significance of bringing these investors in particular at this point in time in AwanTunai's growth, and what are the opportunities this opens up for the company moving forward?
I think in terms of the opportunities, firstly, we've got that recognition globally with
Right.
investments, as you said, from Japan, Thailand, Finland, Norway, in addition to the existing IFC and the
NFC,
bank
right?
CBCs, right? So firstly, that's a huge achievement in these times, especially where it's hard to get such good quality investors. Now, coming back to AwanTunai, right? We're a simple lender. We've got one product, which is inventory purchase financing,
Mm.
and we lend to the FMCG space. Now, lending may seem easy and straightforward to many, but it is amazing how many investors that I came across did not understand lending. We've spoken to fintechs in the ecosystem where investors pushed founders to grow fast without really building risk management. We've been quite contrary in our approach. Our philosophy has always been we solve for risk before solving for scale. So investors like IFC, FinFund, Norfund, and the CVCs of MUFG, OCBC, BRI, they've been really supportive. Our investors support our vision of building a long-term, efficient, profitable, and sustainable business. So I think DFIs, they typically invest in companies with a positive social or economic impact.
Right.
We are all that and soon to be profitable.
Mm.
So I think it's been our privilege to have such high class investors join our cap table. And with DFIs and with bank CVCs, as a fintech lender, this opens up access to capital and helps us scale because lending, as you know, is,
On both
as a
sides.
business is all about scale.
Yeah. So yeah, I think that just speaks to how much of a mark I want to is leaving globally, and as this mission and the work that you guys are doing are known more widely to many other industry players as well. What does this mean with the work that you guys are doing? You mentioned solving for risk first before solving for scale, taking this contrarian approach. What does this mean in this environment, in today's lending environment? And you see a lot of lending companies struggling, and understandably they have different business models from AwanTunai as well, but it's still lending and it's still in a similar space. So what is AwanTunai's role in this landscape with this approach that it's taking?
I think what AwanTunai has focused on is solving for the missing piece, which
Mm.
is building risk management in this segment, which has traditionally been constrained by banks in terms of getting access to capital because banks usually ask for hard collateral. And even if you look at banking, I'm not going to name banks, but I've seen a lot of banks where SME banking was an orphan child, right?
Mm.
It didn't sit in retail. They tried to move it to corporate bank. The corporate banker said, hey, these are too small ticket sizes.
You're
Look.
not the first guest to say that, interestingly enough. So, yeah.
So SME bankers, obviously, they did not have the right tools to analyze this credit. SME bankers were using a very heavy CA-based approach, which corporate bankers do, which is very expensive. And also, secondly, it's not granular enough. That's why we saw many blow-ups happen. So I think the missing piece is to find that data. And as one of the investors I recently met is said that what you've sold was basically forensic accounting, right? We don't have the traditional data sets to look at. So what do? We look at other unique data sets, such as transaction data. We reconcile them to bank statements. We look at mobility patterns. We look at patterns of buying and selling by suppliers. Like, for instance, wholesalers have certain times when the sales peak, say at 10 in the morning. They peak again at 5, then they drop at 6 because they go for their Friday prayers or their
Mm.
evening prayers, and
Right.
then back at 7, 8, these times peak. So This allows us, these data sets allow us not just for underwriting, to solve for underwriting, but also fraud detection. Now, what we do is we take these data sets, we triangulate this data, and we project based on the backend data. And that's where the real path to breaking out is. One thing to note is I think internal fraud is one of the biggest causes of lending program failures. And we have seen it across many lending companies of late. Okay, so we have devised controls on our people and data, and we've utilized data sets to detect external as well as internal frauds, which is a big part of our risk management. And I think what we're doing differently is we've branded ourselves as a supply chain partner. We have seen a lot of 100% digital lenders come in, but they don't really work out because SME segment that they really need a human touch, the human relationship. So a lot of our technologies are backend. We're not asking them to use some fancy apps. We're basically
Right.
collecting the data through our ERP plugin, and then we're running advanced algorithms and pattern analysis to underwrite as well as to detect fraud. So I think what we're essentially trying to do is capture data, process the data efficiently, and essentially run forensic accounting at a low cost.
Yeah, actually, I wanted to dive a little bit deeper into the how you try to manage the costs of such an operation, right? Where although there is a lot of technology involved in the back end, as you did mention, I presume there's a lot of human touch also that's involved, where you have to go out in terms of sales as well, talk to these merchants, onboard them, and all these, and make sure that they're using. I guess they're able to use the ERPs properly and all of these things, and making sure everything, the whole operation is sustainable. Like, how do you keep tabs on this as CFO? You did mention earlier that it is part of your job, like you do liaise a lot with the sales team and the operations and all.
Of course, the first point of understanding the breakdown of your costs is to understand unit economics, right? How much of sales is each salesperson bringing in? How much of revenue is each salesperson bringing in, right? In terms of sales, I think back in the day when we were trying to get merchants to use an app, right? We were burning money because with merchants, they're tech illiterate, right? They're not tech savvy. That's why we built appless solutions, which I think Dino's covered in one of your previous
Yeah,
podcasts, right? We
that was
don't,
a big highlight.
we,
Yeah.
so we've automated some part of sales, right? So like micro lending, this is something which can be easily automated. So we've built prototypes and we're running these prototypes and we've seen success, right? So we have managed to control our risk in the micro SME segment lending, which is we've seen startups in the NPL rate of anywhere between 12 to 60% annually, and we've contained this to single digit numbers, right? Now, in terms of how do we manage costs between tech and the human touch, right? So at in lending, what we need to primarily solve for, it's a fraud problem. Yes, there is a huge credit risk, but a large part of NPLs is driven by fraud. At least back before we started our fraud detection programs, almost 80%. So what we really needed to do was validate that this is a real inventory purchase transaction that we're financing. And we looked at existing ERP softwares. We looked at ERP softwares, accounting systems, which did not really solve for it. So we built an ERP system in house. Then the second aspect was trying to get users to use this ERP system. Now, a lot of mom and pop stores, you can't get them to use complex systems, let alone even apps, right? So we automated that aspect of data entry because we would just see their our suppliers downstream sales, and that's how we would give credit to the merchants. But for suppliers, there's different categories of suppliers. There are suppliers who are still using pen and paper or just about Excel, happy to use our ERP system. For the others, we decided we care about the data, not how whether they are entering it. So we created an ERP plugin. So we're able to extract all that data on that ERP plugin and use that data sets to manage fraud, manage underwriting. So I think in terms of cost, right, there has been an evolution where we have cut down on sales expenses, which were related more to acquisition of customers in terms of using the app to, and we pivoted that sales team to actually building a larger wholesaler and distributor base and then solving for downstream lending as well at the same time.
Right, right. Which is where you get the data, which is like,
Absolutely.
yeah. Yeah, I think that's an interesting point of with a multi-sided kind of platform where you focus your acquisition and sales channels can really impact the costing and the unit economics of the whole thing. And it's quite interesting that AwanTunai, as much as we've talked just in this conversation about the complexities of the operation, and even with Dino, like our conversations can last for a whole movie. But it's actually just one product so far, right? Like
Yes.
really just this purchase supply chain financing. In terms of growth moving forward, what have been the conversations around expansion? Is it really just going to be focused on scaling the loan book with this particular product, or are there considerations for other kinds of products that you're thinking about moving forward?
So just in the traditional FMCG supply chain, and this is excluding the modern retail and the alpha marts,
Mhm,
within this space, there is 100 billion of inventory that flows through three levels. So it's 300 billion of flows that we are looking to finance. So obviously there's a lot of banks and SME bank and other fintechs already in the space. But there still is a gap, a lending gap of about 50 billion in total assets, which we can easily look to solve. Now, our lending is to the traditional FMCG suppliers, which are basically the backbone of the Indonesian economy. These are the staple, the daily necessity goods.
mhm,
And what we have come to realize is our ERP plugin solutions, we can detect patterns in this particular industry. And just within this industry, we can easily grow to a $10 billion loan book without having to change either the product or the industry. So, what
mhm,
we see in terms of growth is loan book growth and regional expansion in Indonesia. I think my key areas of focus come from building the supply, so creating the lending capital to
right.
grow the loan book and keeping the cost base efficient. So, running an efficient business and growing profitability. We're currently EBITDA positive and we're looking to be profitable by the end of the year. All this, which is on the back of one product, which is inventory purchase financing. And I think the only other investment that we will need is investment in tech going forward as we scale, because
Yeah.
now that we have solved for risk, we are now starting to solve for scale.
Yeah, I mean, if it works, it works, right? And one thing that
Yes.
interested me in what you mentioned is the importance of actually building up the supply, and how have I guess the conversations evolved since your time joining post Series A in AwanTunai, and then leading up to now with the Series B extension. How have the conversations with these FIs and banks and investors evolved in terms of pulling the supply together?
I think when we speak to banks first, a lot of banks have seen many pitches from fintech lenders. Everyone says we have 0% NPLs, right? One of the challenges is to get banks and private credit institutions convinced on our credit performance that this is real. And when I joined AwanTunai, there were three lenders. We had one large private credit fund and we had two Indonesian banks. Today, we have over nine Indonesian banks. We have global banks which are going to deploy through their Indonesian branch, and we've got private credit institutions lined up. So obviously, we've seen a lot of loan book growth, and that has been as a result of our credit performance. So I think one of our main tasks in achieving scale and profitability is showing great credit performance, and to show that as we continue to scale, the credit risk is either the same or actually getting better. It's been quite interesting in terms of the conversations that we've had, and also the fact that in this round, IFC obviously participated,
Mhm, yeah.
Insignia participated again as existing investors, and for bank CVC like NUIP and the likes of Norfund and FinFin coming in, they've added a lot of credibility to our business model. Also, I think banks like to see profitability or near-term profitability as they lend. And
Right.
now that we're in that sweet spot, which is near profitable, we are seeing a lot more supply opening up.
It's quite interesting given how given the high interest rate environment and all these different economic uncertainties, that with a business model that works, you can really find the right partners to really grow this business. And to wrap things up for this first part, I wanted to move into our make or break corner actually, and dive a little bit deeper into your own personal journey, trying to achieve all this from the Series A to Series B sort of leg of AwanTunai's journey. What has been the biggest make or break moment throughout these past 2 years that you can share with us?
I think the break moment was just after I joined AwanTunai, which is the tech winter.
I thought so. Yeah, if I
So
had to guess.
so as I had mentioned earlier, I was the first CFO of Avantun I've
Mhm,
ever had. So obviously the first couple of months were getting the financials ready, the financial streamlining the financial reporting process. I had to review the entire finance function and get the financials ready. And by the time we were ready to go to the market, oh wow, it was tech winter, right? And it was a very long, cold tech winter. This part, which is the break part, forced me to go through a lot of introspection, not just personally, but for AwanTunai, right? Which is investing time in reviewing processes, reviewing systems, getting the right talent, really building up the model to see, is this something which investors will buy into? It was a long process. I think the make moment, obviously, in addition to closing Series B with world class investors in these times, I think one of the make moments was I was invited earlier this year to speak at Davos at the World Economic Forum. And we were recognized as the most impactful startup in the world. And I think what we are doing is really changing lives and bringing prosperity to Indonesia. So we are building the next wave of financial inclusion in Indonesia, which will hopefully be a textbook example for financial inclusion globally.
Yeah, and on that note, if you guys want to hear more about her experience at the Davos, tune into part 2 coming out next week. In the meantime, thanks so much for tuning in. We'll see you guys in the next part of our conversation.
Thank you, Paolo, for having me on the show. Thank you.